This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Lynn back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Lynn's picture saying looking for the downloads. Okay, Eric, what are your thoughts here on the equity markets?
Last week, I said to expect a relief rally back up to the 200-day moving average, but then I cautioned that what happens there could be critical to watch, with an eye toward the possibility of another leg down toward lower lows. Well, so far, that's exactly what's been playing out. We got that relief rally, which stalled initially at the volume-weighted average price line, then it dipped down to retest the short-term moving averages as support, which held, and then it rallied again on Wednesday, but still closed below the 200-day moving average, which is now co-located with the 21-day moving average, right at 5,800 on the June S&P futures contract. The big question is what happens next. A decisive move and close above the 221-day moving averages could signal the beginning of a V-shaped recovery if this correction is really over, and frankly, I'm kind of skeptical. So what I'm still watching for closely here is a failure of this rally at or below 5,800 and a new leg down. If that happens, a daily close below the lowest of the three short-term moving averages, which right now is the 8-day moving average at 56.54 on the June futures contract, that would indicate that we're probably headed toward a retest of the recent lows, if not a leg towards new lower lows.
Eric, I agree that the downside is actually still a risk. On page 2, I have the chart of the S&P 500, but what I put was the 50-day moving average instead of 200-day. And I think that's a much more relevant level around 5,900 because it's also where the Fibonacci retracement zones are. During bear market rallies, like when something is oversold and snaps back, at least in previous bear cycles, snapbacks of like 5 to 10% were quite normal. We still can't rule out a little bit more squeezing up of several hundred S&P points to the upside. But generally, if the market stays below the 50-day on a sustained basis, then the downside window is open in my mind. And that leaves the risk for another full leg lower like you were suggesting. Now, there are a couple things that I'm watching because we had a 10% market correction. And in a 10% market correction, they happen, frequently, even once a year. You have these pullbacks and then the market is a buy on dip and turns. But if it's the beginning of something more ominous, like a sustained bear market decline where this turns into a 20+% decline in the markets, there's a couple of things that are commonly evident. So on page 3, I have the volatility index, the VIX. And what I wanted to, with the boxes on there, highlight that during bearish periods, such as the 2022 bear market, you can observe here that the VIX stayed on a sustained basis for an entire year. In fact, almost a year and a half above the 20 level on the VIX, maybe a couple closes below, but generally the vast majority of the trading was up with the VIX above 20. Now, in the early 2023 till present, we have seen a much lower vol regime, a period where the VIX stayed between 12 and 20 on a sustained basis of lower volatility in a bull market. Now, even though we had numerous little scares, like, for instance, the yen carry trade unwind and things like this that caused temporary spikes, the key was that it very quickly mean reverted back into that lower trade range. So now here we are close to a month of the VIX trading above the 20 level. We're currently trading at 21. And one of the big puzzles to solve here, which would support the idea that we have more selling to come, is does the VIX stay at this higher elevated level to start to resemble the 2022 period, where essentially option premiums command a certain amount of additional volatility premium for that volatile market condition that is often associated with market declines. Also on page 4, I have the chart of the junk bond markets. One of the things that we have seen was a little bit of a breakdown in junk bonds, and seen credit spreads for junk bonds start to actually rise from actually decade lows. And one of the interesting observations to make is that a lot of times 5 to 10% market corrections can occur without rattling the credit markets. But typically, when the equity markets are going through something deeper, such as a 15, 20, 25% market correction, it is almost always accompanied by stresses in the junk bond markets. And so one of the things that I'll be looking for as a confirmation as to whether or not this is still got further breaking on the downside is whether or not these junk bond markets fail to rally here and also roll over. And if all of these things are lining up, higher sustained volatilities, credit markets breaking down, it will really start to support the idea that the S&P 500 is vulnerable to the downside. The one thing I'll just leave it with there is that this bounce, it could still last a little bit longer. I would not be shocked if we printed 5,900 on the S&P. But at this stage, my view, very similar to yours, is that after this little bit of a bounce that we're getting here, another full leg lower that could see us under 5,400 and even getting a stone throw away from 5,000 is entirely on the table.
Patrick, let's touch on options-based hedging strategies again this week. What strategies are most useful if you're hopeful that this market is maybe about to recover, but you're still concerned that we might be nearing the top of a dead cat bounce and about to roll over toward new lower lows?
So, Eric, when talking about hedging, particular hedging with options, the considerations are how much volatility premium are you paying and what is the risk associated with that? Because the more you pay for the protection and the hedge, the less asymmetry there is and less payoff for hedging your downside risks. But the second risk is that if you overpay for the volatility premium, and like we were showing on that VIX chart on page 3, if volatility suddenly collapsed back to 12, 13 on the VIX, you're going to take a lot of vega damage on the contraction of you overpaying for the option. But let's just assume one thing. If you are bearish and you believe that we're entering some form of a more prolonged correction cycle, if it starts to mimic the 2022 period, then this 20 level on the VIX is actually very close to the lower boundary of where volatility would be. And therefore, this from that perspective makes volatility still reasonably priced. So someone who just turns around and buys a put option here as a hedge, so long as that's your thesis, you certainly can take on that risk. But equally, one of the things that one can consider is using strategies such as collaring. Collaring involves you then turning around and selling a covered call to earn an income premium to help offset the cost of the put hedge. In this kind of market environment, that is pretty interesting because even if you're not entirely outright bearish, at minimum, one can make an argument that the upside of the market is relatively capped. That the idea that the S&P is imminently going to be ripping toward 6,500 to 7,000 in another leg of a major bull market is maybe not very realistic. And so therefore selling some premium above on the call options is a way to help reduce the cost of put hedging and allow you to create a lower net gross exposure and less volatility and take away that left tail risk associated with the downside of the markets.
Patrick, last week you told our listeners about a webinar going in depth on repair strategies, which I think you've already held now. For those listeners that might have missed the live event, is the recording still available?
Eric, last week we talked about the ratio call spread as a repair strategy, and it continues to actually be one of my favorite things. When an investor catches themselves stuck in a stock, needs to lower their cost base for a break-even exit, accept no substitute for this ratio call spread as a way of getting yourself out of that tough situation. One of the things we did in that webinar that we did earlier this week is talk about the comparison of using this versus traditional dollar cost averaging. And it's very important for listeners to see how they compare and stack up against each other. Those of you that missed that special webinar, the recording is still available. You can find it at bigpicturetrading.com. The link is also in the Research Roundup email. It takes you to the site and you can watch the free repair strategy webinar available on the site. All right, Eric, let's move on to the dollar index.
We've been in a tight consolidation between 103 and 104 on the Dixie for 2 full weeks now. I think the more likely resolution to that consolidation is lower below 103, but it's been slow in coming. A daily close above 104 or below 103 should be the tell for the next leg.
Well, Eric, my view even a month ago was that the dollar index was holding at higher highs, was consolidating in a very traditional wedging or flagging formation that was very typical of a continuation pattern to go higher. But over the last month, we saw some serious technical damage that has now brought the dollar back into the trade range that prevailed over the last 2 years. Now, that doesn't make me outright bearish the dollar, but it does neutralize almost all short-term bullish enthusiasm. Now, we could certainly see a very quick little jump back to 105 to 106 on the dollar index, but is at this moment neutralizing my stance on the dollar and expecting it to be far more range-bound in the same ranges of the previous 2 years, I think is a very good position to be in on the short term, and then we'll see whether new trends develop from here. Let's move on, Eric, because I wanted to get your thoughts on oil.
We're into the third week of consolidation between 65 and 68 on WTI. I'm still leaning toward a downside resolution, meaning new lower lows. But there's also geopolitical events heating up, so that's a pretty low conviction view at this point. I guess to expound on that a little bit, I'd say I still think that we're headed toward new lower lows because of President Trump's intention to get us there if a geopolitical escalation on the Gaza front doesn't undermine that. And it seems like that's becoming increasingly likely, hence my low conviction.
I just want to put oil back into perspective here because we just had a pretty serious drop in crude oil prices from the $80 level back down to this $66 level. Let's call it close to a $15 drop in just a few short months. Typically, with something that oversold, you would see even a $7 or $8 bounce in crude oil just as a reaction from being incredibly oversold, just a reflexive snap that is very typical in technical price action. Here, we have seen only a few dollar reaction over the last several weeks as everyone is leaning straight into the selling the moment there's any reaction in oil. We are trading right at the 52-week low, right where we were trading at previous September, and it's not attracting any buying to react it off of there. This type of price action is very weak, and that leaves oil in a very vulnerable state where we could have a temporary breakdown to to a lower low, maybe even see $62 or $60 on a temporary basis. Even though that is the most immediate downside risk, that doesn't make me think that there's a huge downside for oil. It's just simply not bullish right now. It's hard to justify anyone buying it at the very moment, and some short-term weakness could kind of be create that little capitulation moment where a bunch of traders throw in the towel on oil, and that might actually create a trading bottom in the month to come. And so I'm respecting the prevailing downtrend right now, looking at the vulnerability there, but also thinking that that would lead to an opportunity if there was another leg down from here. All right, Eric, we can't talk charts without touching on gold and this wicked rip to the upside. What are your thoughts here?
Patrick, I've had a structural long position on gold futures for several years now, and I finally started taking profits on that position this week. Now, to be clear, I absolutely am still long-term very much bullish gold. The fundamental argument for dollar devaluation in absolute terms remains very strong. But the daily and weekly stochastics and RSIs are all flashing extreme overbought, with the daily RSI at 85 and the weekly at 81. So I think this market is overdue for another swing lower. But more to the point, this has been a terrific ride, with gold more than doubling in the last 5 years since it dipped below 1,500 in March of 2020, just as the pandemic was beginning. So the question I'm asking myself is, do I really think it's realistic to expect gold to double again, like to $6,000 in the next 2 or 3 years? Well, I definitely think $6,000 gold is possible. In fact, I'm pretty confident we're going to see it, but not in the next couple of years, especially with the extreme overbought signals the stochastics are giving us on the weekly chart. But do I think it's plausible for uranium to double in the next couple of years? Oh, I fully expect it to. And I don't think a triple on uranium in the next 2 or 3 years is at all out of the question, whereas I think that's pretty darn ambitious for gold. So it's not a case of not being bullish on gold anymore. It's a case of knowing that the game is to sell high and buy low. Gold is high right now. Uranium is low. I won't be surprised if uranium gets lower before this is over, so I'm raising cash from my profit taking on gold and buying only a little bit more uranium mining shares right here, while saving most of my dry powder for a washout in the junior miners if we see a bear market develop in equities more broadly.
Well, Eric, for me, gold has measured moves all the way up to 3,200, so I'm not yet too eager to start trimming positioning on alongside of gold. I was looking to see whether or not that consolidation was going to be a little bit longer in its duration. It was a very short little multi-week break that gold took, and this breakout is decisively bullish because not only is gold breaking out, but we got silver attempting to break out. All the gold miners are being bulled very well. There is clear money flow going into this space. It's starting to get attention. I don't want to disrupt this current bull impulse. I think there is still room for this to go, even if it might be the middle innings of this game. Now, Eric, what are your thoughts here on uranium?
Well, we finally had an up week on uranium and the mining shares, but I'm actually a little less optimistic in the short term than I was last week. For a little while, we were starting to see signs of uranium shares outperforming the S&P, in the sense that uranium miners were trying to grind out a bottom, maybe drifting to slightly lower lows as the bottom was falling out and the S&P was dropping like a rock. But the relief rally on the S&P was quite brisk, while uranium miners bounced, but with less enthusiasm. So now those slow stochastics and RSI indicators on the daily uranium mining charts that were at extreme oversold a couple of weeks ago, well, they're climbing steadily back up and starting to enter short-term overbought territory, suggesting a consolidation or another swing lower probably is what comes next. So as I mentioned in my gold commentary, the profits that I've taken on gold are definitely earmarked to buy more uranium shares adding to my already overweight position. But I'm not rushing to use up all my dry powder just yet. Most of the uranium-related charts are still below their 21-day moving averages, so technically speaking, the trend is still down until proven otherwise. I'm also watching for a potential scenario to play out, and this one is completely speculative, so it might not happen. I think we're getting closer, Patrick, to Putin and Trump reaching an agreement to end the Ukraine proxy war. I see that as strongly bullish for uranium, but I think there's a good chance the market will get it backwards at first. A lot of people seem to think that lifting sanctions is going to open up access to Russian uranium because Russian uranium exports have been banned, so they think it's bearish. In reality, Russia isn't a very big producer of uranium, but it's the world's biggest supplier of conversion and enrichment services. And those conversion and enrichment services becoming openly available to the West again would mean more demand for uranium because now we've got the conversion and enrichment capacity to do something with it. So I think there's a good chance that if and when agreement is reached to end this war, uranium shares will dump on a wrong way signal that will create a fantastic buying opportunity. The main reason I've started taking profits on my gold position is that I want to redeploy that capital to buy the hell out of that end-of-war dip on uranium shares if we get one. And since the war ending could very likely be gold bearish, since gold is also a hedge against geopolitical risk, war comes to an end, it would make sense for gold to take a big nosedive. I'd rather lock in my profits way up here at all-time highs, knowing I'll be able to buy plenty more uranium shares on that end-of-war dip if it happens. Now, again, that's all armchair speculation on my part, and I'm lining up quite a few dominoes there. So what I just described might never happen, but if it does, I'll be ready to buy the hell out of it with a whole lot more junior miners being added to my portfolio on the dip, using proceeds from gold up here at what for now is all-time highs. And yeah, it might not work out that way. I might miss even higher highs on gold, but even if I'm late to the trade and have to buy uranium at a higher price than now because it turns out the bottom was already in, I still think the upside is going to be much bigger on uranium than it's going to be in gold in the next couple of years.
Well, Eric, I had that chart of the Sprott physical uranium on page 8. And in my mind, we have actually reached some incredibly oversold levels, selling at a proper discount to net asset value. The selling pressure has slowly subsided on the short term, and it's trying to uptick here. Generally, my view on uranium here is that it's now cheap enough to potentially own for long-term investments, because I remain bullish uranium and looking for the upside. But what we're going to have to watch is to see is, will we start to see flows coming in? Will we see accumulation patterns? Will we see that that uranium and uranium miners start to actually take flows again and get bought on dip? Right now, it's very early in this cycle. You pretty much have to be buying it as a value investor now, just simply by price level alone, which I'm sure a certain number of our listeners would find appealing. But I'm going to be looking technically as to when we see a shift to more bullish price action, that the actual upside is getting underway. I wanted to wrap up by looking at page 9, the copper chart, and just what a rip copper has had for a direct retest of last year's highs around 510. Now, I think here that while this is a level that copper may pause and create a flagging formation or consolidation, but this is a bull run on the upside, and there's every chance here for copper to make a fresh 52-week high and really give it a go on the upside. What's particularly interesting, though, for me, Eric, is the fact that copper miners have not reacted. This has been the commodity alone. The commodity's been running, and we haven't seen the Freeport McMorans of the world really join the party yet. And the question is, can we have a scenario where copper is in a huge bull run and running, and the miners not reacting. It's a very interesting puzzle to solve that I'm not totally sure I've got figured out just yet. And finally, on page 10 of the U.S. long bond or T-bond futures, and clearly we just had the FOMC come out, mixed messages of stagflation, but it's an environment I think that allows bonds to generally gravitate back towards the top end of its ranges. With us holding now above the 50-day moving average on the long bond, I think there's every opportunity for still another leg higher. Now, I'm not outright bullish, like thinking we're going back to 2% yields or something crazy like that, but after that devastating bond bear market that lasted several years, we've established over the last year and a half this trade range that has been the new base for Treasury bonds. And for us to approach, let's say, September's previous high around 127 is not unrealistic. We were just there 5 months ago. And I think there's room for bonds to gravitate again back to the top end of the ranges. And so it's more of a tactical short-term trade than a bigger macro call.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.